everyone. Welcome to our DAT market update for this week. It's November 5, first Tuesday in November. We all know what that means. Hope you voted. It's episode 314. Today, I'm here with co-host Chad Kennedy and special guest Larry Gross from Gross Transport Consulting, author of Intermodal In Depth and recipient of the Silver Kingpin Award, an annual award given out by IANA. Congratulations, Larry. It's certainly an honor to have you on the show.
Well, thank you. The pleasure is mine as always, Dean. Thanks for having me.
Yeah. How's things, Chad, in Florida?
Things are good. We do have another hurricane. It looks like heating up in the Gulf. Currently, last update I saw, it was aimed towards Louisiana, right. But it's still early, so something we'll keep an eye on.
Yeah, I looked at produce volumes out of Florida last week. They were down about 80% compared to the start of the produce season this time last year. Volumes get pretty flat in October, but they were literally flattened, especially tomatoes, veggies, and strawberries. The early plantings of strawberries are going to be problematic for the start of the produce season next year out of Florida. Yeah. Larry, for those that are new to the show, can you tell us a little bit about yourself before we dive into the market update?
Well, sure, Dean. I mean, I've been involved in the intermodal world in some form or another for my entire career, which now is over 44 years. Basically the first half of that career, I was involved in an intermodal piece of technology called the road railer, which was a truck trailer that could operate directly on the rail. You might call it piggyback without the rail car. And that technology had a very good run, but ultimately the industry decided to go with the double stack domestic container technology. And in fact, sadly, the last road railer train ever operated just this past summer. Norfolk Southern closed down its last operation. So with the road railer coming to a close, I had to reinvent myself. And there was no intermodalist out there. It was not clear that an intermodal analyst could make a living. But I decided to give it a try because really that was the only thing I knew anything about.
Right.
So started Gross Transportation Consulting, which is a one-man shop with a specialty in intermodal back in about 2003. And what do you know, it turns out you can make a living as an intermodalist. And so I've been putting out a monthly analytical report more or less since then. It's subscribed to by many of the major intermodal players. And my job is a 40,000-foot analyst that covers the intermodal space. So I don't get into particular companies. That's a security analyst's job, but rather what's happening in that sector, where's it going? What are the key trends? What are the key drivers? That's what I talk about.
Yeah, it's fascinating. I love the monthly report and the insights, especially those you shared with us at Inland in Chicago a couple of weeks ago. All right, Larry, we'll bring you back in a few minutes. I'll quickly go through the market update. Chad will give us a look at what's happening in the contract side of the market. I'll start off with some of the key points that we're watching here in the spot market. Dry van flatbed rates literally flat last week. Reefer rates are starting to rise as they do every year at this time. So we're seeing pretty strong seasonality again this year, right on cue. Some of the demand indices we're watching, the ACT Research Volume Index was down about 5 points in September. Overall freight demand is growing, but we're seeing private fleet growth resulting in some capacity or some demand staying on the private side as opposed to for hire. Tim Denoyer's got some good reports out on that in the Cass Shipments Index that came out, I think, last week. Florida's Hurricane Milton made a big impact. There was a 1-2 punch down there with the two hurricanes. Milton and Helene. It's damaged a lot of the veggie crops. We're seeing about 1,300 fewer truckloads coming out of Florida at the moment compared to this time last year. As you know, Florida is the second largest producer of strawberries. And about 99% of the strawberry acreage was right in Hurricane Milton's path, which is where Chad lives, of course. So we're watching that fairly carefully. Plantings for strawberries start September, November. Between September and November, and then start harvesting in December through the spring. So we're looking to see if that recovers. The ISM PMI came out last week. Manufacturing activity contracted again in October. A little bit faster rate compared to the prior month. So according to the ISM PMI, folks out in Colorado, demand continues to be weak. So we're watching that. Although the new orders index did remain in contraction territory, was up 1 percentage point in September. Don't forget the market update that'll be out tonight. We're looking at Christmas tree shipping season, which has begun. It started to peak, starts to peak now and runs through the Monday after Thanksgiving. We've got another article on Jason Miller's truckload ton-mile index, a really interesting story about zero-emission refrigerated trailers being trialled by BPW in the UK. They use an e-power axle on the trailer to recover energy while the vehicle brakes and travels downhill, and that recovered energy is being used to power the refrigeration unit, and a really clever device called a power half width sliding bulkhead to control temperatures as the parts of the load are delivered. And also a look at the Association of Equipment Manufacturers Agriculture Machinery sales for October. All right, let's dive into the market update. Load to truck ratio for dry van. Load posts were down last week at the end of month. A little bit unusual. We normally see volumes increase as shippers clear their docks at the end of the month. Volumes dropped slightly. Carrier capacity decreased. Load to truck ratio was up slightly, about 4.35. In refrigeration, reefer load postings were up 3% last week, sitting about 13% lower than this time last year, though. Carrier equipment posts were down last week. Load to truck ratio up slightly to 6.39. And in flatbed, load postings were down, also down by about 8 percentage points. Still about 9% higher than last year, though, in flatbed. Load to truck ratio remained mostly unchanged at 14.34. Having a look at our year-over-year movement in spot rates, the volume of loads moved, as opposed to loads posted, loads moved down by about 1% last week. That's about 4% higher than this time last year, so a little bit more volume this year. The rates down slightly, down to sitting about $1.66 a mile. So not a lot of movement, essentially flat. That's about 2 cents a mile higher than the 3-month trailing average, and sitting about 10 cents a mile higher than this time last year. And in refrigeration, the volume of loads moved last week was flat. Reefer capacity did tighten, though, as we expect, driven by some regional changes in demand with fall produce and Christmas trees. We're also seeing turkeys and hams start to move ahead of Thanksgiving. Spot rates up 4 cents a mile. The average paid to carriers was $2.02. That's 11 cents a mile higher than last year. And in flatbed, line haul rates were steady last week. The national average was $1.97 per mile, despite a 2% decrease in the volume of loads moved. That's about 9 cents a mile higher than they were last year. So if you look at across the board, about 3 equipment types, they're all sitting about 10 cents a mile higher than this time last year. Remember, folks, this is excluding fuel, so they're line haul rates only. All right, let's dive into our short-term forecast before we bring Larry back in with our question of the week and Chad's forecast for contract rates. This is the spot market forecast side of our business. These go out 35 days. These are essentially heavily weighted by longer-term seasonal trends. The blue line is the 7-day rolling average. These are for loads over 550 miles, excluding fuel. So really long-distance line haul only. The green is what Ratecast is expecting out 35 days, and then you've got the higher and lower bands in gold and red. Let's start with dry van. Ratecast is expecting rates up 8 cents a mile over the forecast range period, which goes out to the 7th of December. Last year, Ratecast said rates would rise about 7 cents per mile over the same period. They actually went up about 9 cents per mile. So this year, it's looking for an 8 cent per mile increase through the first week of December. Typically, rates will rise about another 3 to 5 cents a mile by the time we get to the year-end period. So again, the rate forecast is much in line with last year's directional rate trend and what we see from a seasonality perspective. In refrigerated, we see a very different chart. Very strong seasonality through Thanksgiving. Again, no surprise here. Rates expected to be up 8 cents a mile to just after Thanksgiving on Cyber Monday before they drop off. Last year, after Cyber Monday, they dropped about 6 cents a mile until the week before Christmas when they started to surge, and then they increased in that period to New Year's Eve by about 20 cents per mile. So again, strong seasonality there exhibiting in the forecast, and flatbed essentially flat through early December before taking off through year end. So a big difference this year is a lot more seasonality in the forecast. Markets behaving more like we would expect it to do from a rate direction perspective. So with that, it's over to Chad to have a look at the contract side of the market.
Yep, thanks, Dean. So everything Dean just covered is from that broker to carrier perspective in spot. So I'll cover this week a mix of contract and spot from a shipper's perspective. So as I look at this trend line here, going back to 2016 for dry van, what we're reporting is similar to the contract rate index that I've reported in the past in prior weeks, but it's an index to 2016. So you can see that top graph there, very flat to 2016, and then you can see the change over time since 2016. And so if you look to the far right there, basically very flat rates for dry van. And this is the mix of contract and spot, everything all together from a shipper perspective. It's about 15% spot mix. But what's interesting is we finally, in the bottom right-hand corner there, you can see we finally have inflation for shippers. So we've crested over the 0% here. It's actually 0.5% inflation for the month of October. Most of that, as you can see in the top line, it's really helpful to look at these two lines together. But the top line is very flat. So that year-over-year effect is telling you a lot more about what happened last year, where you see that trend coming down, which is making that year-over-year go up into the positive. So let's move on to reefer. So reefer, similar story, very flat over the last year to the far right there. And you can see that trend getting pushed up a little bit there, not quite at 0%, still in the negative. So shippers are still enjoying deflation from a year-over-year perspective in reefer. Reefer spot mix is about the same as well. Let's go on to flatbed. Flatbed's a little bit different. So 24% spot, a lot of seasonal lanes, short-term lanes. And so that drives a lot of that. And the pattern looks a little bit different here on the top there. Didn't get quite the decrease as dry van and reefer did through this deflationary market, but still deflationary nonetheless, and still down below 0%. So still shippers are enjoying deflation from a year-over-year perspective. And again, that mix here on flatbed is 24% spot. And then finally, let's take a look at intermodal. Since we have Larry on the call this week, I plugged in the intermodal rates from a shipper perspective. This is really 95 to 99% contract rates that we have from our shippers. You can see a slight tick up there over the last few months, and inflation is still below 0%. So I'm sorry, just about to hit 0%. And so we're getting very close, and we are seeing some increases over the next month or over the last month or two. That's it for the contract rates.
Thank you, Chad. All right, so let's bring Larry back in. Lots of questions, Larry, but let's start off with something we saw on a recent podcast. You were talking about the gap between intermodal, domestic IPI, inland point intermodal, and international. You said it was quite wide at the moment, but there's lots more behind that. So maybe we could start with sort of, what we're talking about when it comes to IPI and how that differs from international, or ISO as you can call it, and then how the difference is so unusual at the moment between volumes on the both international and domestic.
And Larry, before you answer, if you don't mind, asking for a friend, could you define IPI and break it down for some of those that might not know?
You bet. So yeah, let's just lay the groundwork a little bit before we get into the weeds on that. If we talk about intermodal, then it's roughly, from a North American perspective, about a 50-50 mix between what I'll use for shorthand, international and domestic. And international, and IPI is just another jargon term for international, inland point intermodal, IPI. That's the movement of 20s and 40s and 45-foot ISO containers from port to inland and back. That's the international segment. The other roughly half of intermodal from a North American perspective is what I'll call domestic, which is primarily domestic containers, 53-foot domestic containers, which don't go typically on the ship. The only ships that they go on are the ones to Puerto Rico and a little bit perhaps to Hawaii and Alaska. And then whatever's left of trailer on flat car, which back in the old days was known as piggyback. So we're looking at roughly 50-50 when we look at the total intermodal market. But the reason that this is a useful distinction is because these two segments operate according to very, very different economic drivers. And that's certainly the case right now. So to just give you some numbers, overall intermodal, total intermodal was up it's up about 9%, a little less, 8.8% year to date. And in September, it was up 7.4%. So, good growth on intermodal, certainly compared to the sort of lackluster performance we've had over the past couple of years. But when we break that down into international and domestic, well, international is up 15.5% year to date. And domestic's up 2.8% year to date. So that is a huge differential. And that differential is lasted right through September. Those sort of numbers were 13.2% and 2% respectively. So what is happening here? Well, there are a couple of things that I think that are driving certainly this international strength. One is that we've seen a migration of import volumes away from the East Coast and towards the West Coast. That is an intermodal friendly change because the length of haul off the West Coast is much longer and intermodal share of West Coast origins is much higher than East Coast because of that length of haul. Why is the volume moving? Well, there are two main reasons. One is that we have the Middle East conflict and the Houthi rebels firing missiles at every container ship other than the Russians and the Chinese that go through the Red Sea, forcing all of those ships to go all the way around Africa to get to the East Coast. So what that has done is added a lot of cost to East Coast routings and changed the calculus between East and West. So that is one reason why we're seeing more volume migrate to the West. Then you've got congestion issues stemming from the ILA, the port dock workers strike, which the contract expired at the end of September. We had a brief 3-day strike, which was suspended but not solved. They made an agreement on the wages, but there are still some very hefty issues that are still on the table, most importantly, automation. And we've only got a 3-month breathing period. So January 15th, this extension of the existing contract runs out. And so it's, I won't say very likely, but certainly very possible that we could have a repeat strike come January 15th, which is more or less in the middle of sort of the mini boom, which happens before the Lunar New Year when all the factories in Asia shut down for a week or so. And so you get a little bit of a surge of volume trying to get in before that happens. And this will occur in the middle of that. So this is a continuing source of uncertainty. The other issues are you have strong retail sales, which is a big component of what's happening, as well as volume moving earlier than normal, in my opinion, because of all of this uncertainty. Not to mention tariff uncertainty. We've got, in case any of you forgot, we have a little bit of an election coming tomorrow with potentially huge tariff implications. And certainly some of this strength that we're seeing is volume moving early to meet perceived tariff threats. So there's a lot of moving parts to this thing.
Right. Yeah, there's a lot. We're seeing truckload volumes up out of California about 14% year over year, which is kind of unusual. National volumes are only up by about half that. So we're certainly seeing more volume come off that side of the country.
We're also seeing rates climb out of California a little bit faster than the rest of the country. So that lines up.
Yeah.
So yeah, I think when you look at the domestic side of intermodal, it's very much tracks, Chad, what you're saying. And intermodal has a little bit, their domestic intermodal has a little bit of a higher international component to it because there's a fair amount of transloading, maybe 10 to 15% or 20% of what's happening domestically. Intermodal is actually transloaded cargo going into domestic containers at the port. So it all ties together, I think.
Yeah, Larry, I was talking to some shippers and they were busily moving 53s out to the West Coast, or empty ones, to reposition them to take advantage of this volume. So it was an interesting email discussion we had sort of offline with that group that we're in about container turns per week, I think it was called. But you made a really good observation that there was a significant number of 53 domestic boxes stacked or not in circulation. How do you look at that as it relates to extra capacity that the intermodal market might have that's sort of untapped at the moment if there was a surge in volumes?
Well, there's certainly, I think, is capacity out there. Probably a more important limiter than containers at the moment. Domestic containers potentially is chassis, and then you have terminal capacity and all of the other moving parts that are required to operate in synchrony for intermodal to be effective. When we look at the containers that are stacked, the private container operators, which are the ones that are buying containers these days, the domestic container market can be divided into two fleets. The private fleet, which are folks like J.B. Hunt and Schneider and UPS and FedEx, and then the rail fleet, which are people like Union Pacific and CSX and Norfolk Southern and the Canadians. They all own their fleets of domestic containers. And roughly 20% of the North American domestic container fleet is rail owned and 80% is private. And it's only the privates that are investing in new equipment. And they were very, very aggressive, I'll say 18 months ago, expecting, I'll say, a quicker rebound in domestic intermodal activity. And so they bought a substantial amount of domestic containers, which all come from China. And then it turns out they overbought. But that's not a big problem from a container, a domestic intermodal operator, because the container is a relatively inexpensive asset to acquire, and it's an inexpensive asset to store because you can stack them.
Right.
So you're not going to see, I think, people in the intermodal sector, players in the intermodal sector, reducing pricing in order to put this idle capacity to work. It just doesn't have enough economic leverage.
Right.
But when the volume comes back, then certainly I think they'll be able to respond very quickly because of these stacked containers.
Got it.
Makes sense.
Sorry, go on, Chad.
Sorry, Dean. Larry, I was going to ask, how much is an intermodal container? And Dean, how does that compare to a typical trailer?
Gee, I haven't looked at it lately. I'm going to say I think they're probably somewhere in the 15, 16 grand range, something like that. I'm doing that from memory.
Yeah, you're probably looking at least triple that for a decent one, Chad.
Wow.
Yeah. Larry, talk a little bit about transloading, because we see a couple of points where transloading can occur onto the roadside if there's a commodity that needs to move, mainly Ontario, the Inland Empire, and say Savannah, where there's been a lot of warehouse development. Do you have a sense of how much moves by road, and what's the decision between rail and road? And is there a specific commodity that is suited towards unloading an international box?
I'm just looking aside here to get to a different chart. So from a rail perspective, the transloading is not, there is, I'm sure, a lot of transloading from container to trailer happening in Savannah, but that is not a market that I'll say intermodal sees a lot of. Once you no longer have an intact international container in a place like Savannah, where the lengths of haul are relatively short, you put it in a trailer, it's gonna just go to destination by road.
Right.
The situation is very different if we talk about LA, for instance, which is 2,200 miles from Chicago, where a lot of that volume is going, or Dallas is maybe, a little bit less than that, but still long haul. And there, overall intermodal share, according to my estimate, is running somewhere in the high 60s. So what that means is, let's say 68% of the TEUs that are coming into LA are coming out on the rail in one form or another. And of that, if I just run down here, I would say about 60% of that is transload and 40% is intact or IPI. The reasons why people are transloading, there are a couple. One, I think, is the most important, is increased flexibility. It delays the time when you need to make a decision as to where the goods need to go. because if you are running IPI, you have to make that decision when the container leaves China. But this way, you only need to make that decision when the container arrives in California.
Got it.
And there's also, I'd say, a speed aspect of it. This is a faster way of getting the volume inland. And then finally, there's a cost aspect, which is there's about a 3-to-2 or 5-to-4 ratio of ISO containers into 53-foot domestic containers. You have less containers to move. So there's an economic aspect to it, but I think that's a secondary play here. So, the ratio of transload to IPI, it bumps around a little bit. Seasonally, it typically is at a high for transload in the fourth quarter because of the need for speed and flexibility as you get into the holiday shipping season. And so I'll be looking for it to bump up a little bit in the fourth quarter, but 40% international, 60% transload is about a good ratio for that particular market.
Okay.
Larry, is the intra-US intermodal market, has the length of haul that it's able to service shortened? I know when I was a shipper in a former life, we kind of targeted 500 miles as the break point from taking anything from dry van over to intermodal. Is that still a good rule of thumb, or has that gotten a little bit shorter?
Yeah, I think it's a good rule of thumb, but I have I would propose a little bit of a different rule of thumb, which is very crude but surprisingly useful, and that is for intermodal to work, no more than 1/3 of the door-to-door miles can be highway miles. 2/3 need to be rail miles. So, if you look at a 500-mile length of haul, well, that can work, but your highway miles have got to be pretty minimal, and the freight needs to be really close to origin, to the terminal at origin and destination. If you have a long haul, you have many more highway miles to work with. Now, having said that, if you look at the again, we're distinguishing between international and domestic.
Yep.
In the third quarter, if you look at international average length of haul, terminal to terminal, this is the rail piece, about 1,430 miles. And domestic is a little bit longer at 1,470.
Okay.
That's cool. So look, very long haul from your perspective, and that's the average.
Right.
You've seen a big swing in the international length of haul because of this west. First it was west to east, and now it's east to west. So international got down to 1,350 back in late 2023. Now it's back up into almost 100 miles. That's a huge swing.
Sure.
Domestic, we haven't really seen that kind of change.
One more question. As a shipper that's planning my procurement cycle throughout the year, I get this question quite a bit. Is there a certain time of the year that's beneficial for a shipper to bid out their intermodal freight?
That's kind of, I would not have an opinion on that. That gets into sort of those details that my 40,000 foot view enables me to avoid.
Yeah. Is there a seasonal slump? Maybe January, February, or July, August?
Reality for intermodal is different than truckload. And as I understand it, truckload peak is typically going to be sometime in the second quarter. We're much more of a fourth quarter orientation, and October is the biggest month of the year for intermodal.
Makes sense.
I just pulled some data while you were chatting. Overall line haul rates in dry van, Larry, are up about 7% year over year nationally, but up 20% on Los Angeles, Chicago. So that's kind of unusual, but we're also seeing a lot more volume, about double the volume move on that lane. So to your point about the migration of freight to the West Coast, we've certainly picked up a little bit of it on the truckload side, probably as a result of some of that transloading that you've been talking about.
One other thing that's driving volume into LA Long Beach is the continued disruption in Canada. And that's one I want to call your viewers' attention to, because we're going to get another round here. In Western Canada, we had a disruption in July with the rail strike, which was very quickly ended by government intervention. But now we have the potential for another port strike there, the ILA going on strike or being locked out. I'm not sure which way that's going to go. But that is going to move discretionary volume once again into the U.S., whether it's the PNW, and I expect you'll see some of that, or LA Long Beach. There's a substantial amount of volume that comes into Western Canada, Prince Rupert, Vancouver, that moves into the Chicagoland area, moves into the American Midwest via Canadian railroads. That volume is very discretionary. I might call it jump ball volume. And with the prospect of more disruption, importers are going to reroute that cargo into U.S. ports where it looks more secure.
Do you have a sense of the duration of this strike? Any guesses?
No, I didn't even see it coming. So I certainly can't tell you when it's going to end.
All right. Well, you know more than we do. So yeah, we'll have to dig into that. I guess we'll start to see that in our data shortly. We'll keep an eye on that. Thanks for the tip.
Yeah, we've seen big increases in the PNW as well as LA Long Beach. I'd be interested to see what your rates look like coming out of the Seattle Tacoma region.
Yeah. All right. Larry, before we wrap up the show, how can folks get in touch with you if they need more information or would like to subscribe to your reports?
Well, you can reach me at lgross@intermodalinDepth.com, all one word, intermodalinDepth. And I'm on LinkedIn. I post under the name Intermodalist. And you can reach me on the phone at 516-455-8988. And I look forward to hearing from some of your viewers.
Yeah, I love your posts on LinkedIn. Lunch with a View is always a highlight of my week. You live in a beautiful part of the world out there.
Yeah, I'm out here in Durango, Colorado, and yeah, I would agree. I'm very lucky to be able to work here and look at my 40,000-foot view. I got a little bit of a jump. We're at 6,500 feet here.
Exactly. Fascinating. Thank you, Larry. All right, let's wrap up the show. On the current edition of the Freightvine podcast, Chris Kaplis is talking to Samuel Parker and Chad Kennedy, talking about the Shipper Summit and at DATCon. Next week, we've got Tim Denoyer from ACT Research. That he'll be the week after. Todd Amon is on from ATBS next week. With that, make sure you sign up to the alerts on the show, subscribe to the channel, DAT Freight and Analytics on YouTube and LinkedIn. And with that, another show is in the books. Be safe, be nice to everyone. Make sure you vote, and we'll see you again next week at 10 a.m. Eastern, 7 a.m. Pacific.